Hello, welcome to Unit 2, Accounting Process and Rules. So we have been discussing accounting theoretical background in the previous session. We have discussed the process, the purpose, the objectives, the advantages, and the functions. All these things we have already discussed in our previous session. Here we are going to discuss about the entire process of accounting and the rules in accounting. So here is our area of discussion, and the first thing that we're gonna discuss is introduction to the topic and accounting process. The process we already discussed in session 1. The same thing we'll once again we'll recall it here. And what is an account? We will see the system or the structure of the accounts and classification of accounts, the principles, and finally the accounting rules. So these are the topic that we are going to discuss in this session. Let's start with the introduction to this topic. I mean our chapter, our unit 2. So all of you remember about the accounting. Accounting is a systematic process of recording the financial transactions and classifying, summarizing, and communicating the result with the interested parties. That's what the system of accounting. So the main functions, as I said, it include recording, classifying, summarizing, and interpreting. Interpretation include, interpreting and communicating. So these four are the major functions of accounting. So every time you should remember this, and whenever you are writing the meaning of accounting, you should point out these functions, and all these functions are included in our accounting definition as well. So the first stage in accounting is recording, isn't it? Recording, where we will record the transaction. The recording transaction is done with the journal. Sometimes it's called as primary book. So journal, we will record the transaction, and the recorded transaction based on the similarities of the accounts in those transactions, we will post to respective ledgers. And later, we will be preparing financial statements as the summary of these ledgers. So the summarization, this summarizing is done through preparing financial statement such as statement of profit or loss and balance sheet. So this is the entire structure of accounting. So here we will see the process once again. The first function, that's what we are doing with recording transaction. Recording transaction is the first function of accounting. So the transactions, the financial transactions once identified, we will be recording these transactions in journal. So journal is the book that's used to record transaction. Right? Journal is the primary book that is used to record transactions. And remember one more thing. If you want to record a transaction, you need an evidence. So in journal, to record a transaction, we need evidence. So evidence, from where we'll get the evidence? From where we can get the evidence? Evidence means for every transaction, there should be some supporting documents. So those supporting documents are known as memos and vouchers. In order to record the transaction, we need evidence or proof. That proofs are invoice or any memos, vouchers, anything. So without proper evidence or proof, we cannot do the function recording. So we'll be recording the transaction in journal, and the later we will be classifying the transactions. The recorded transactions in the journal will be classified. So as we know, the journal, the transactions are recorded in as different accounts. That there will be debit and credit account will be shown. These accounts are grouped. The similar accounts are grouped in single journal. Sorry, ledger. So the similar transactions or similar accounts are grouped into single ledgers, separate ledgers. That's what we call posting. So remember the terms. Those transactions we are recording in journal is known as what? Journalizing. So remember the term. Recording the transactions in the journal is known as journalizing. So journalizing is the recording transaction, and classifying the transaction into ledgers is known as posting. So posting is classifying the transaction into ledgers. So here we are classifying all the transaction into similar ledgers. Then now we have different ledger accounts, and later we will be summarizing these ledgers. How we will summarize? By preparing statement of profit or loss, that is income statement and balance sheet. And sometime before preparing the income statement and balance sheet, we used to prepare trial balance. Trial balance is prepared to verify the arithmetical accuracy. Arithmetical accuracy in the sense we should check the debit and credit are arithmetically accurate. So if the debit and credit are equal, the trial balance will show as tallied. Then we can ensure that accounts are free from arithmetical errors. And remember one thing, we cannot say that if the trial balance is tallied, everything is correct. It is completely free from errors. It is not like that. There are two types of errors: errors affecting trial balance and errors not affecting trial balance. Some errors, the presence of these errors will not be affected in trial balance. So there are certain errors. So we can't say that if the trial balance is agreed and there is no error, such a statement we cannot say, because still there is possibility of errors. But even then, the basic errors that related to the arithmetical accuracy, that means the total of debit and credit, that can be found out by preparing trial balance. So anyhow, we can prepare the trial balance and verify the arithmetical accuracy. And remember, trial balance is an optional statement. It's an optional statement. It's not an account. It's an optional statement to verify the arithmetical accuracy. And once we verify the arithmetical accuracy, we'll be preparing final account, just like trading and profit and loss account and balance sheet. Trading and profit and loss accounts are known as income statement or statement of profit or loss. Then balance sheet. So this is what called summarizing. So the ledgers that we are summarizing in trading and profit and loss account and balance sheet is known as the third function, summarizing. So once we summarize, we'll be having this trading and profit and loss, where there we can see the profit and the balance sheet as well. The balance sheet will be showing the net worth of the business. That means the total assets and liabilities. After this, we have to interpret the result. That means if we want, we can do further analysis. That means further examination, and we can make reports over these things. Then that can be communicated to the different stakeholders such as investors, management, government, and whatever. Then this accounting cycle continues for year and year. So accounting is happen every day. The recording function happen every day, and the ledger account preparation, everything is going on each and every day, and the preparation of financial statement will be mostly done at the end of a period. Okay, so this is the process of accounting. So once again, remember what's the process of accounting: recording, classifying, summarizing, interpreting, and the accounting cycle continues. So this is a cycle. It is followed by throughout the life of the business. Okay, and remember, in accounting, usually we will close the books of accounts at the end of the year. So for 1 year only we are doing the accounting cycle, and later we will close the books and we'll carry forward the balance to the next year and we'll do it again. That's what we practices. Then what is an account? Once we recorded the transaction, then next we have to post those transaction into ledger accounts. So accounts is shaped like letter T. Yes, account is shaped like letter T. At the bottom, I hope you can see this. So it is shaped like a letter T, isn't it? See, this is the format structure of account. So it is shaped like a T. So shaped like a T means it is having two sides. It is a T, and it's, sorry for the writing. So it is shaped like the T, and it is hard to write with the pen. Okay, So this is the T. This side is known as debit side. This side is known as credit side. Okay. And this left side, as we said, it is debit side. The right side is the credit side, and each account will be having a name. For example, cash account, furniture account, building account, Ramesh account, or Suresh account, or whatever it is. Okay, so the transaction from the journal will be posing to the debit or credit side based on the effect, based on the rule of accounting. So how to determine that the transaction will be recorded on the debit or credit side? That's based on accounting rules and principles. So there are certain accounting rules, and before you go into the accounting rules, you should know the classification of accounts. Then only you will be able to apply the rule of debit and credit. So here we see the classification of accounts. Basically, accounts are classified into three categories: personal accounts, real accounts, and nominal accounts. So there are three classifications of accounts. So the first one, personal accounts. Personal accounts, as the name says, personal. So transaction related to individual or entities, just like Ramesh account or Suresh account or DS Traders account or Brightech Limited or Reliance Limited or Tata Limited, whatever. The name of the, it start with the name of the person or name of the organization, it will be the personal account. And there can be some representative persons like salary outstanding, insurance prepaid, and so on. These all are known as representative account. That means for the technical purpose, we will consider this as a person. Okay, so these are the accounts, I mean personal accounts. And remember, one of the important thing, capital account and drawings account are the personal account. Capital means the amount contributed by the owner. So we'll be preparing a capital account in the name of the owner. It will be a personal account. And the amount withdrawn by the owner from the business, that's what drawings, that will be a personal account. So personal account examples, any account with the name of the persons, and it include capital and drawings account. Okay, so this is about personal account. So it is really easy to find out whether this account is personal or not. It will be starting with the name of the person, and only the difficulty is regarding representative accounts. So representative accounts are the, it's like a technical account, just like salary prepaid or salary accrued or outstanding, insurance or rent accrued, like that. Okay, we will see this how it will be. I mean, this representative account. And the second classification is real account. So real account means the transaction involving assets or properties. The important element of these real accounts are assets. So these are the accounts related to the assets of a business. What are the assets? Assets are the resource owned by the business, isn't it? Any resource owned by the business is known as assets. So any account related to asset will be considered as real account, just like furniture account, machinery account, cash account, then goodwill account, motor vehicle account, whatever, property account, land account. So inventory account, trade receivable account, debtors, these all are real accounts. Okay, then nominal accounts. The third category, nominal account. So nominal accounts that include expense, loss, incomes and gains. So basically income and expense, or loss and gains. So anything. So income and expense, that's what included in nominal account, just like wages account, salary account, commission account, sales account, purchase account. These are the example of nominal account. So this categorization, it is really important. Then only you will be able to classify the ledger, I mean to apply the rules of accounting. So this classification should be there in your mind: personal account, real account, and nominal account. Personal account, real account, and nominal account, these are the important classification of account. And personal accounts include the accounts in the name of persons, just like Mohammed or Suresh or Rajan or DS Traders or PK Traders or Reliance, capital account, whatever. Then real account involves all the accounts that's consisting what? Liability, liabilities. So liability, sorry, not liabilities, real account that's consisting assets. Sorry for the mistake. Real accounts mean the assets. Assets, all assets are collectively known as real accounts. Assets accounts are collectively known as real accounts, just like furniture, machinery, motor vehicle, cash, etc. Then last case classification, nominal accounts. So nominal accounts include all the income and expenses or loss or gains. Okay, so these are the three classification of account. These three classifications are very important. Based on these classifications, we are going to apply the rule of debit and credit. So we'll see. So here is a summary of this classification. Real accounts, nominal account, personal account. Okay. And this impersonal accounts, this classification, do not confuse, because accounts are basically classified into personal and impersonal. Impersonal means real and nominal accounts. So there are only three classification, 1, 2, and this is the third classification. Okay, then principle of double entry. Here we are going to apply the rule of debit and credit. So debit and credit is the two sides of the coins. Like in accounting, for each and every transaction, there will be equal debit and credit. So if you take any of the transaction, there will be equal debit and credit. So those who are new to the field of accounting, I mean, if you are new to learn this accounting, sometimes you may have difficulty about what is this debit and credit. So it is easily you can understand by thinking like, the first thing what I have to tell you is that when you learn accounting or when we practice accounting, the one thing we should keep in our mind is that the business and the owners both are not same. So the business and owner both are not same. These are different persons. The first thing that you should keep in your mind is that business is a person, owner is a different person. Both are not same. And when we do the accounting or when we are practicing the accounting, we should be in the side of business. So we are the business. When we learn accounting, we are the business. You should think from the business side only. We shouldn't think from owner side or employee side or customers or suppliers. You don't have to think about them. You should think about the business only. So business is a person, is an artificial person. That way you should think. Then only you can apply the principle of accounting. So as a business, we are the business. Okay, we are the business. Then there are different parties. One of the person or one of the parties the owner. The other parties are our employees, customers, suppliers, government, and whoever. So all these parties are all these persons are different to us. Okay, they are separate to us. We are not same. So if you are thinking in that way only, you will be doing correct. And then I'll tell you what is debit and credit. So we are the business, right? For each and every transaction, if you are checking, there will be a receiving and giving aspect. That's what called debit and credit. If you check any of the transaction of the business, there will be a receiving and giving aspect. For example, as the business, we are the business, right? We are buying a machine. We are buying a machine. So a machine worth of 5,000 rupees. So we are buying a machine worth of 5,000 rupees. There will be a receiving and giving aspect. What we are receiving? We are receiving a machine, isn't it? We are receiving a machine. For that, what we gave? We gave 5,000 cash. So in each transaction, if you check, there will be a receiving and giving aspect. This is really important. So in every transaction, it will be like, if we are buying furniture, it will be like this. And for the supplier or the bank, we are depositing money in our bank. So we are giving money. Okay, so we are giving money means the cash we are depositing into our bank. So we are giving 1,000 cash. We are depositing 1,000 cash, means we are giving the cash. And what we are receiving, we are having a bank account and the money is there in our bank. So the receiving aspect is bank balance. So there is a giving aspect and receiving aspect. Then the next one, the owner start the business. The first and most important transaction of the business will be the owner start the business. When the owner start the business, what the business get? Suppose the owner start business with 1 lakh. The owner start with the business with 1 lakh. So business is receiving what? Business is receiving cash. Business is receiving cash. So cash is the receiving aspect. And giving aspect for the owner, it is a giving aspect, right? Is paying money. So for owner, it is the giving aspect. That's what we call capital. The money introduced by the owner is known as what? Capital. For each and every transaction, there will be a receiving and giving aspect. In our personal life also, if we gave something only, we will receive it. If we are receiving something, meaning we might have gave something. So that's what called the same thing, only debit and credit. So the next thing is what? Which will be debit, which one is credit? That we are going to discuss. So the principle of double entry is that's require every debit to have a corresponding credit of equal amount. That's what I said here. In a transaction, for a credit, there should be corresponding debit. So if there is a 1,000 rupees debit in a transaction, there should be 1,000 rupees credit. It will automatically come as this receiving and giving aspect. And all transactions are recorded in accordance with the principle of accuracy and completeness. So the main principle behind recording the transaction, that means journalizing the transaction, is principle of double entry or dual aspect. Dual aspect, that means each transaction will be having equal debit and credit. Once again, if we summarizing this topic, we can say that for each transaction, there will be at least 2 accounts, and one account will be debit, the other account will be credit, and the amount of debit and credit will be equal. That's what called principle of double entry. And here we see the principle of double entry and how it will be affected. Okay. So once again, we will see the examples for the rule of double entry or dual aspect. So here we have certain transaction. We see the first transaction, commenced business with 50,000 as capital. So business started with 50,000. So this is a transaction, it's a financial transaction. So as we said, for each and every transaction, there will be a receiving aspect and giving aspect. So what is the receiving aspect? So you should remember the point, we are the business, right? So business commenced with 50,000 as capital. That means owner brought the capital, isn't it? If the owner brought the money, then only business is having money. So we are the business, owner is a separate person. So we are receiving, as we are the business, we are receiving money, right? So cash is our receiving aspect. Then what is the giving aspect, or who is the giver of this money? Is the owner or proprietor. And the receiving aspect, the related account that we're gonna create is cash account. And for the proprietor or for the owner, the money given by the owner will be recorded in account called capital. And remember, the capital will be the liability of the business, because owner is a separate person. The business and the owner, these are the separate person. So here is the business, here is the owners. They are separate persons. So here 50,000 is given by the owner, isn't it? 50,000 is given by the owner to the business. 50,000 is given by the owner to the business. So when now if somebody gives you the money for fee, you have to return it back, right? The same way business have to return this money somewhat later. So there is a 50,000 rupees liabilities towards the owner. So that's what called the capital is treated as liability, because the owner and the business both are separate. Okay. Then we'll see the next, and the amount involved is 50,000. The receiving aspect is 15,000 and the giver aspect also 15,000. So one will be debit, other one will be credit, and the next stage we will be talking about which one is debit, which one is credit. Okay. The next one, bought goods. We are buying goods for cash 5,000. So what is the receiving aspect? That is goods. We are receiving goods. And what is the giving aspect? we are giving cash for this purchase. Okay, so there are affected accounts are goods account and cash account. And the next one, bought goods from Ramesh and company on credit. So we are not paying cash, but it is on credit. We will pay them later only. So here what we are buying goods, so we are getting goods, isn't it? So goods account. And who is the giver of the goods? That is Ramesh. We are not paying cash, but his goods is given by, the goods are given by the Ramesh and company. So Ramesh and company account is the second aspect, that is giver aspect. The next, sold goods for 12,000. So we are selling goods. Selling goods mean the goods is given. So here is the giving aspects. The goods are the giving aspect, and we are receiving money out of it. So cash is our receiving aspect. Then sold goods to the Ajay on credit. Here the fourth transaction, we sold goods and we received cash. And this fifth transaction, it is sold on credit. That means the Ajay, he didn't pay. He may pay us later. So he is known as our debtor. He is our debtor. So he will give the money later. So for him, we sold the goods. So here giving aspect is goods, and the receiving aspect means the goods is being received by Ajay. So we can say this is the receiving aspect. So in this way, if you check any transaction, there will be a giver and receiver. That's what called two effect of this transaction. And there are remaining transaction, so you should check the remaining transaction. I'm not going over all those transactions. For everything there will be a receiving aspect and giving aspect. So I don't want to do this everything. Let me see if there is anything important. Just quickly I'll go through this. Paid cash to Ramesh. So we are paying cash. The cash is giving aspect. So who is receiving this cash? Ramesh. Received cash from Ajay. So Ajay is giving and we are getting cash. So cash is receiving aspect, other one is giving. Then paid rent. We are paying rent. So that is cash we are paying, and we got a benefit of accommodation. That means that's an expense. Rent is an expense. Why it is an expense? Because of this expense we got a benefit. That's why rent account is the benefit. I mean the receiving aspect. Then purchase a typewriter. We are getting the typewriter and paying money. Then paid interest on loan. Paid interest on loan. So we are paying money. I mean paying cash, but the interest is the benefit for that loan. I mean the loan is a benefit. That's why we are having an expense. So remember, if we are paying for any expense, mean that out of that expense we got some benefit. So that's the receiving aspect. Okay. Then I hope now you understood the receiving and giving aspect. For each an account there will be a receiving aspect and giving aspect. Okay. Next, if you understood this receiving and giving aspect, the next thing we are going to apply the rule of debit and credit. And this rule of debit and credit is determined based on the nature or the classification of account. So first we will see about the personal accounts. So for personal accounts, how the rule is applied. Let's see. So the rule is that debit the receiver and credit the giver. That is the rule about personal accounts. So in a personal account involving transaction, debit the receiver, credit the giver. Here see one of the example, cash received from Ajay. So there is personal account Ajay. So here Ajay is giving the cash, isn't it? So giving aspect, the personal account, who is the giver, that should be credited. So Ajay account will be credit over here. And here you see paid cash to Ramesh. So here Ramesh is receiving. Ramesh is a personal account. So since he is receiving money, this Ramesh account will be debited. So in the same way, debit the receiver, credit the giver. That is the rule behind personal accounts. The next is rule behind real accounts. As we know, real accounts consist of assets, isn't it? So the rule is like the debits what comes into the business. That means debits what comes in. Debit what comes into the business, and credit what goes out of the business. So credit what goes out. So that's the rule. So if you are buying a machinery, see here we bought a typewriter. So typewriter is an asset, isn't it? When we are buying the typewriter, we are getting. So typewriter comes into the business. So here typewriter will be debit. And instead we paid cash. So cash also is an asset, but we are paying cash. So here cash will be credit. So in this way, the real accounts are applied. And the nominal accounts. Nominal accounts case, debit all expenses and losses. So loss and expenses are debited and credit incomes and gains. Incomes and all gains will be credited. So remember, incomes and gains are credited and expense and losses are debited. So this is the summary of the rule. In case of personal account, debit the receiver, credit the giver. In case of real accounts, debits what comes in, credits what goes out. Then in case of nominal accounts, debit expense and losses, credit incomes and gains. So this is the rule of debit and credit, and this should be there in your mind. If it's there in your mind, you can record any kind of transaction. So your the first and most thing, you should be able to classify these accounts into real, personal and nominal. And this classification is done based on the nature of the accounts. Okay. And before that, I'll tell you one simple trick that is not discussed in your books, but one more simple tricks is there to decide about debit and credit. By looking into the commonly, we can say if there is an asset or expense account, and if this is increases, it will be debited, and if there is an income or liability, if it is increased, it will be credited. We know that each and every transaction there will be minimum 2 accounts. So any of the account will be fall under asset, liability, income, expense. So these are the 4 broad category of accounts: asset, liabilities, income, expense. So if it is an asset account, if it is increases, it will be debit. So remember, asset increases, debit. So what will be asset decreases? The opposite, credit. So we can say asset increases, the rule is what? Debit. Then if the asset decreases, the opposite will happen. It will be credit. Then expense also the same as asset. Both asset and expense are the same treatment. Expense increases debit, expense decreases credit. And next about the liability. Okay. The next about the liability. The liability increases. We know that asset and liabilities are opposite. So here asset increases debit. So here liability increases, it will be the opposite, that is credit. Then if liability increases debit, mean what happen if the liability decreases? It will be debit. Then for income, the same as liability. So you don't have to remember everything. You just remember only this. Expense or asset increases debit. Then expense or asset decreases, it will be credit. And we know that expense is the opposite of expense is income, or opposite of asset is liability. So the opposite, liability increases, the effect will be the opposite. That means it will become credit. So you can follow this way or this way. It is up to you, whichever is convenient that you can use. Then here we gonna apply the rule of accounting. The rule of accounting. So first there is a transaction, the transaction that we have seen the previous slide, the same transactions only. Here, commenced business with 50,000 as capital. So owner introduced money, isn't it? So we have already seen that there is cash account and capital account. So cash account is what? Real account, and capital account is personal accounts, isn't it? So here we are receiving, that means cash comes in. So as per the real account, what comes in, that should be debited. Then personal account, capital account is a personal accounts. So credit the giver. That's what we learned the rule. So your capital account will be credited, and you can apply the rule I said beside. What is that rule? Cash account is an asset, isn't it? Capital is the liability of the business. So when the business is receiving money, asset account increases. That means the rule is debit. Then when the business is getting money from the owner, the liability increases. That means capital increases. That means capital increases means credit. So any rule you can apply, you can find out the debit or credit. Then bought goods for cash. Business is getting goods. So it is an asset, that means real account. So we are receiving goods. So receiving aspect debit. Then what we are giving? Cash, giving aspect. I mean cash is goes out of the business. That is credit. And the same rule again we can apply. Both goods and cash, both are asset. But here we are getting goods. So goods increases, asset increases. The rule will be debit. And here we are giving cash. So cash decreases, the rule will be credit. The same thing happen only here. So we can apply any of this transaction. Okay. Then goods from bought goods from Sohan on credit. So we are buying goods. So we are getting goods. Goods comes into the business. So goods is a real account that comes into business, mean that will be debited. That's what it is, debit. And the giver of the goods is what? Sohan is a personal account. So giver will be credited. So Sohan is credited. Okay. Then sold goods for cash. So sold goods for cash mean we are getting money. So cash comes into the business. It is debit. Then who gave the goods? I mean we are selling the goods. So the goods is given, isn't it? The goods go out of the business. So that will be credit. Then sold goods to Vijay. Sold goods to Vijay. So we are selling goods. So the goods is the real account that goes out. So goods will be credit. Of course, goods will be credit. And the person who received the goods, that is what Vijay, his account will be debited. Then the next, purchased furniture. Purchased furniture mean we are getting furniture, isn't it? The furniture is the real account that's received. So it will be debit, and we are giving cash. It will be credit. So you can apply any of the rules that you feel comfortable. Either this asset increases debit, liability increases credit, that rule, or this account categorization rule. So anything you can apply and decide about the debit and credit. Then sold old typewriter. So think about the rule. Sold old typewriter. So when we are selling something, we will get money. So there will be cash account. So we are receiving cash. Cash comes in. Cash comes in means it is debit. Or cash increases. Cash is an asset that increases debit. That way also. Typewriter also an asset, but that goes out. That means that decreases. That will be credit. Asset decreases, credit. Purchased postage stamp. Postage stamp, it is an expense, isn't it? So expense, we are getting a benefit out of it. That means postage is debit, or we can say all expenses are debit, and we are giving cash. So cash is credit. Paid salary, out of paying salary we might have got a benefit. So that's the receiving aspect. Or expense, all expense are debit. That rule also we can apply. Expense comes, that should be debit, and we are giving cash, that should be credit. So if we found one side, the opposite side will be the the other side will be the opposite. If we found one side credit, then the other side will be debit. Okay. Received interest. So here it is an income. We are receiving interest. That means we are getting money. So cash comes in, real account comes in, debit. Then interest. Interest is a nominal, income. So nominal accounts, all nominal accounts, that means all incomes are credit. Okay, it is credit. So out of this we can have a conclusion. So about the cash, if we are paying cash, if we are paying cash, then what will be the effect? Cash account will be credited. If you are receiving cash, then it will be debited. Then all expenses, the expenses will be debited. All incomes, it will be credited, isn't it? Then the totally we can say, if there is an asset increases, that will be debit. If there is a liability increases, that will be credit. And if an asset decreases, mean it will be credit. If liability decreases, mean it will be credit. And the same rule is applicable for expense also. Asset and expense, the same rule. Income and liability, the same rule. So you should remember in this way also. Then it will be much more easier. And here is our one of the previous year question. Explain the step involved in the accounting process. It 10 mark is the same question I have shown in the last PPT. I mean the unit 1 also the same question only, the accounting process. So what is the accounting process? Recording, classifying, summarizing, and interpreting. Interpreting include communication also. So these are the basic functions of accounting, and this accounting cycle continues. So this is the process of accounting. So you should remember this process in this way. Based on this process only, you should remember the meaning of accounting. Okay. And here we got one more question. It is December 2023. Oh, sorry. The previous one question was 2022. I think there also I mentioned as 2023. And the question is that what are the different categories in which accounting transaction can be classified? So what are the categories? You know, the categories of accounts are real accounts, personal accounts, and nominal accounts. And this is a 14 mark question, so you have to explain those things, and you have to write examples for all those categories. And also explain the debit and credit rules. So what is the debit and credit rules? The rules about real account is that debit the receiver and credit the giver. That was the rule. Then regarding the personal account, debit what comes in. So what comes in the business, any asset comes in the business, that should be debited, and credit what goes out. Then in case of nominal accounts, debit all expenses, and credit all incomes. That means expense also include losses, incomes or gains. So these are the rule of debit and credit, and you have to write the examples for each. That will be better because it's a question worth of 20 marks. So this is about this unit 2. Here we learned about the rule of debit and credit. Now we know how to apply this debit and credit. Based on this debit and credit only, we will record the transaction in the journal, and later we have to transfer those recorded transaction into the ledgers. Okay, see you next session. Thank you.